Hi, good morning. We are meeting today through a recorded session. So if you have any questions, compile them and keep it for next week. When we meet through a live session, you can always ask through chat. So today is a continuation from where we stopped last week. We covered fixed income securities. We kicked off on fixed income securities. We did a basic introduction in fixed income, the types of risk that you encounter, like interest rate risk, liquidity risk. In the case of corporate fixed income, it's corporate debt, it's default risk also. But then the important thing is when it comes to local currency denominated government debt, there is no default risk at all. But remember, if a government issues debt in a foreign currency, there will be default risk, which is called sovereign risk. Right? Then there is also downgrade risk of an entity being downgraded. Now, for example, let's assume that you're only supposed to invest in investment grade securities, right? So that is BBB minus and above. Now, what happens if all of a sudden an entity which at the time of investment was BBB minus gets downgraded to BB plus or below? Then what happens? Then the risk profile changes completely. Right? That's when that's a time when you should alert to your management and take necessary action based on recommendations. You should be able to decide whether it's a good trend, or the trend will reverse, and whether they will get back to an investment grade rating. But if that is not the case and the situation is worsening, then it might warrant an exit. Right? But if it's a temporary thing, and they will go to BB plus and remain at BB plus for some time, that systemically they are exposed to too much of risk, it might be a worthy investment to hold for some time at least. Right, so there are so many implications of credit ratings as well. So the other thing we did was we covered the basic terminology of bonds. Also, how you identify bonds based on the ISIN numbers, International Security Identification Number. And then we did a bit of calculations, some calculations. What we discussed was bond calculations are identical to net present value calculations. If you know net present value, you know bonds. It's as simple as that. Right? So if you are not very thorough with bond calculations, you need to go back to the net present value calculation and make sure you're comfortable with it. If you're comfortable, then there is nothing new to learn. Absolutely nothing new to learn. Right? Okay, so last week, the other thing we discussed was if the yield is more than the coupon rate, then the bond is trading at a discount. And if the yield is equal to the bond coupon, they're trading at par. The bond is trading at par. And if the yield is less than the coupon, it is trading at a premium. Right? So remember these three terms, premium, par, and discount. Right? And also you need to know the conditions under which they trade at a premium. That's when the yield is less than coupon. Par when yield is equal to coupon, and premium when the yield is and discount when the yield is more than the coupon. Right? Okay. So with those in mind, we'll continue from where we stopped last week. So this is a straightforward example. Par value of two bonds, right, of a bond is given as $100, and the price is given as 90 half. Now 90 half means they're given in percentage terms. The price of a bond is usually quoted in percentage terms, right? If you say the price of a bond is 100, it means 100%. So it is 100% of the face value, in other words. So that means if the face value is 100 and the price is 90 half, it is 90.5 into 100%. Right? So you get the price of $90.5. On the other hand, if the price is 102.25 into 100%, it gives you a price of 102.25. Right? So that's how bond prices work. Premium bond, like we discussed last week, the bond price higher than its par value. If a bond price is higher than the par value, it is called a premium bond. The condition is yield should be less than the coupon. Interest rate on the reason is the interest rate on the bond is higher than prevailing interest rates in the market, right? So the yield is, if the yield of the bond is less than the coupon, it is a premium bond. So what actually happens is, if the yield is less than the coupon, right? So yield is the return you get from the market. Now, what determines the yield is the market, no? So if the yield is less than the coupon, that means the market interest rate is less than what the bond is offering, right? There cannot be an arbitrage. That means there is no opportunity for people to make a risk-free profit. And you can't have free lunch in finance. No free lunch. There is no such thing as a free lunch. So the condition is, if the yield is higher than, if the yield is lower than the coupon, people will start buying the bond, which is more attractive than the market, what the market has to offer. So the price of the bond will increase. You know, everyone is buying that bond, then the price and the demand, when everyone starts buying, the demand for the bond goes up, price goes up, right? Price of the bond increases. But if the yield is less than the market, then, sorry, if the yield is more than the market, then no one will want the bond. It becomes nobody's baby, right? So why should you invest in the bond when it's giving 10% coupon, whereas the market is offering a 15% rate, right? So that's when everyone either starts selling the bond or the demand for the bond reduces. When the demand reduces, the price starts dropping. That is what happens. That is why it makes the bond trade at a discount when the yield is higher than the coupon. Okay, so remember, yield is the market interest rate, the return that you get when you invest in the market. Coupon is the return that is offered by the bond. Discount bond is issued for less than its par value, or a bond currently trading below par. So if the price is more than the face value or the par value, it's trading at a premium, and if the price is less than the face value or par value, it's trading at a discount. Term to maturity is the time. This is again the basic terminology when you come across bonds, right? Term to maturity is the time between when the bond is issued and when it matures, at which time the issuer must redeem the bond by paying the principal, right? So when the bond matures, the issuer or the borrower has to pay back interest plus the face value, or the amount of time between now and when the bond matures, right? So if you bought a bond today and it matures in 5 years, the bond actually may have been issued 10 years ago, right? So it was a 10-year bond originally. 5 years have gone. 5 years remain. So it's now a 5-year bond. For example, 4.5%, 1st January 2020, issued on 1st January 2010. Term to maturity from 1st January 2020, 13 to 20 is 7 years, right? You have 7 years to go. Right, so day count basis or the interest rate calculation basis. It gives the basis for calculating coupon. Okay, the easiest way I can explain this would be right. So take for example $100 placed in a FD, right? Let's say this is $100, 100 rupees or whatever, placed in FD at a rate of, let's say, 10% for 1 year. After 1 year, you get interest of 10. Simple calculation. After 1 year, easily you get 10% interest of 10. Very easy to calculate. But what if this is 1 year now? What if it was a monthly deposit? After 1 month, how much do you get? How do you calculate? It's 100 into 1 month, 1 by 12, is it? That comes to Now let's see how many different answers we get, right? It's 1 by 12. 8.33. Now what if this month was January? Then it will have 31 days, isn't it? 365. Then you will get 8.49. But what if it was February? Then it will be 100 into 28 or 365. It will be 7.67. Actually, it should be 83 cents. 85 cents. 70 cents. What if this February was a leap year? Then what happens? It will be 29 or 366. 79 cents. Okay. So you will notice that based on the basis you are using, this is actually 1 over 12 is actually 30 divided by 360. Right? So based on the basis you are using, the interest amount you receive will change. Right? Now this basis is called the day count basis. That is how you calculate interest based on the day count basis. Okay. So remember, day count basis is very important because it determines how you calculate interest. Day count basis. Right? So different countries have their own day count basis. For example, Sri Lanka uses actual. Right? Actual, which is the actual number of days for a month divided by the actual number of days for the year. Whereas US uses actual 360. This is for bonds. Sri Lanka bonds based on actual. Bills actual 364. Sri Lanka bills is actual 364. Bills and bonds in Sri Lanka, I have two different day count bases. So that is day count basis. Very important concept because it decides how much of interest you are receiving. Now, day count basis is used to calculate coupon interest. Sri Lankan treasury bills are based on actual 364, bonds actual, US treasuries actual 360, others, the other basis can be 3360. Now, one important thing is if you are using actual, then the number of days between 28 February and 1st March is 1. Number of days between 28 February and 1st March is 1. But if you are using 30 or 360, right? 30 over 360. That means you're assuming every month has 30 days, not the actual number of days. Right? So then the number of days between 28th February and 1st March is 3. It's not 1, it's 3. Right? That decides how much of days you are calculating interest on. Amortization is the reduction in premium discount of premium or discount of a security as the security approaches maturity. Convergence to the par value. Okay. Right. So let's say a bond price is, you're buying a bond today at 105. In 5 years, it matures at a price of, how much do you receive when the bond matures? You receive the face value of 100, which means the price of 105 over a period of 5 years has reduced to 100. Let me plot this. Price against time starts at 105, and when it matures, it is 100. Right. Now, on the other hand, if you bought a bond, if this bond was purchased at a price of, let's say, 95, not 95, but 95, and when it matures, it gives you a price of 100. So in that case, it was purchased at 95. When it matures, the price increased to 100. Right? So in that case, 95, the price will go up to 100. And 5 will increase to 100. Okay, which means over a period of time, the price will converge towards its face value. The price will converge towards the face value. Okay, which also means now this is the premium, and this portion represents the discount. Over a period of time, the premium of this bond will start reducing, and the discount on this bond will start also reducing. That's called amortization. Premium or discount amortization. Then settlement method is called scriptless security settlement system. SSS, scriptless security settlement system. That means sometime back, about 20 years ago, bonds had script. So every 6 months, you had to go to run to the central bank with the script and claim your coupon check. Right? You had to go with the script. Without the script, they won't give. It's like FD. You have to take the FD to the bank to get your money back. The bonds were similar sometime back. It's not the case anymore. You don't have to take the script plus currently. Right? Script plus security settlement system. Currently called script plus security settlement system. Bid and offer, we will come back to that later. That means there are two prices in market. One is a market buying price, other one is the market selling price. In the yield maturity, right? When it comes to yield, there are several derivatives of yield. First one is the current yield. current yield is the bond interest rate as a percentage of current price of the bond. Interest rate as a percentage of the current price of the bond. Then the yield to maturity is the measure of return on the bond if its yield is held until the maturity date. Right. Yield to maturity. Now we do calculations, you will understand better. Yield to maturity, obviously, as the name implies, if you hold this bond until it matures, how much of return do you get? If you don't sell it, or how much return will you get? That's called yield to maturity. So if your intention is to hold it until it matures, the return that you get is called yield to maturity. But current yield is the return that you get if you hold for a certain period of time. The yield to maturity calculations take into account the current market price, par value, coupon interest, and time to maturity. It's also assumed that all coupons are reinvested at the same rate. Right. Now, the important concept for you all to know is that price and yield have an inverse relationship. There is an inverse relationship between price and yield. Bond yield is inversely related to price. Price yield, there is a negative relationship or an inverse relationship. That is why you see when the green line represents the yield and the red line represents the price, right? So whenever the green line drops, the red line increases, and whenever the green line increases, the red line drops. That is because of the negative relation. It's almost a mirror image. Accrued interest is the interest earned but not yet paid, right? So coupon interest, like we mentioned last week, is spread out through the year. So if you buy a bond in between two coupon payments, it will accrue interest, because on a daily basis, coupons accrue interest. And coupon interest is paid on a daily basis. It is calculated on a daily basis. Interest earned but not yet paid is called accrued interest. So if you bought a bond, if a bond was issued on 1st January 2010 and it was purchased on 1st March 2010, whereas the next coupon date is, let's say, in 6 months, 1st July 2010, if A had purchased and held it on for 2 months, B had purchased and held on for the balance 4 months, A is entitled to coupon of 2 months coupon, whereas B is entitled only for 4 months, not the full 6 months, right? Now, if you take 1st July, B is the person who will get the coupon, but he should only get coupon for 4 months, not for 6 months. So what he does is, part of the coupon will be paid to A, right? That is through accrued interest. A part of the coupon will be paid. 2 months coupon interest will have to be paid to A. The calculation goes as clean price of the bond is the price without accrued interest, right? So there are two prices of a bond. One is the clean price. The other one is the dirty price, right? So clean price plus accrued interest is equal to dirty price. Then bonds with options. Bullet bonds, non-callable, regular coupon paying debt instruments with a single repayment of principal on the maturity date. Now, if there is no other payments in between, and nothing falls in between, only the coupon plus the maturity amount when it matures, then it's called a bullet bond. Right? Only a few payments in between, only the coupon. Whereas callable bonds, now what happens is for a callable bond will be issued. Let's say if the borrower expects interest rates to go down, and after a period of time, if the borrower expects interest rates to go down, he will issue what is called a callable bond. If interest rates go down, he will ask for the bond to be returned. When the bond is returned, he will issue a fresh bond at a lower rate. Right? So he is basically refinancing the previous borrowing at a low interest rate. That's called a callable bond. So what happens is he will include a call option to this bond. Puttable bond, if the investor, now in this case the investor feels interest rates will go up, right? He will want to sell the bond to the issuer at a certain point of time. So if that option, that privilege is given to the investor, it is called a puttable bond. We'll come to this later. But now just have an understanding that there is something called a callable bond, which will be used when interest rates go down, and puttable bonds, which will be used if interest rates go up. Callable bonds that can be redeemed by the issuer prior to its maturity. Right? Usually, premium is paid to the bond owner when the bond is called. The main reason for issuing callable bond is the decline in interest rates. Why you issue callable bond is if you feel interest rates will drop. Puttable bonds, a bond that allows the holder to force the issuer to repurchase the security at a specified date before it matures. Repurchase price is usually set at the time of issue and is usually par value. Right, so related products, repos. If you all are following news, you would have noticed that the central bank is planning to raise dollars through a repo facility through the Federal Reserve. Right. The Federal Reserve, we would have invested in US government bonds. So what the Sri Lankan government will do is they will pledge the US government bonds to the Federal Reserve and borrow against them. Now it's nothing new. It's like a typical housing loan, right? You pledge your property to the bank and you borrow against it. That's called you pledge an asset and borrow. Now bonds are also an asset. If you're invested in a bond, it is an asset. So all you have to do is you have to pledge the bond like you pledge your land and borrow against it. It's called repurchase agreement or repo. An entity can pledge treasury bills or bonds and borrow against them. Interest rates are usually lower than clean borrowing because there is a security. Only thing it happens through what is called an outright sale. Right? So if you are short of funds, you can pledge your assets and security and borrow against them. That's called a repurchase agreement or repos. Right? So examples, the current facility that the central bank is negotiating with the Federal Reserve to borrow against US Treasury bonds. Reverse repurchase agreements or reverse repos. That's when an entity with surplus funds can lend against treasury bills and bonds. Right? So if you have surplus cash and you are not willing to take credit risk, you can use reverse repos. You can lend against security. It's like banks lending against property. It's a secured lending. Such lendings are more secure than clean lendings. These lendings are more secure than clean lendings because now if you take a clean lending, there is always exposure to default, risk of default. But this is backed by security. So you're safe. Yield curve is a line that plots interest rates at a set point in time of bonds having equal quality but differing maturities. So what happens is if you take the overnight rate, SLF, overnight, at 1 day, 4.5%. Then the 1 year treasury bill, or the 3 months treasury bill, 4.3%, 4.6%. Sorry, 4.6%. 1 year treasury bill, 4.8%. Likewise, the same security which is issued by the government is plotted on a graph. And 5 year, 6%. 10 year, 7%. And eventually, if you plot this curve, it is called the yield curve. You're plotting the returns that you get over various tenors for a given issue. Right? In this case, the government. The government is the issuer, they're the borrower. So you are measuring what is the return that they offer. This is called the yield curve. Right? So the same issuer across various tenors, if you plot the diagram, it is called a yield curve. That is how we obtain the yield curve. Right? Now this curve was drawn today at 11:40 a.m. So this is the curve that is valid on the 25th of July 2020 at 11:40 a.m. 11:41 a.m. would be different. Can be totally different. Right? So this is valid only for a split second. Can change. Yield curve is dynamic, it is not static. There are three types of yield curves. One can be an upward sloping yield curve like what we have drawn. They can be flat or even downward sloping yield curves, right? So this is an upward sloping yield curve. Upward sloping yield curve, that means short-term yields are lower than long-term yields. The flat, very simple, hardly any change in yields. Right? Across all tenors, the yields are almost the same, flat. This is upward. And downward is the opposite, where short-term yields are higher than long-term yields. Downward sloping. If you expect the economy to grow fast, then you will usually see upward sloping yield curve. Right? If the economy is going from growth to shifting towards recession, then you might see the yield curve flattening and eventually becoming downward sloping. Right? The yield curve shape can change based on if the economy is going into recession, you will might have a downward sloping yield curve. It's going into recession. A normal yield curve, the short-term debt instruments have lower yields than long-term. This is the most common. You hardly see the other types of yield curves, but not impossible. High yield is required by investors of long-term debt due to risk associated with time. And so, if you want to invest for long-term, you should be compensated. That's why you ask for high long-term rates. Flat yield curve. The difference between short-term and long-term rates for bonds of same quality is very little. Can be seen during transitions between normal and inverted. Right? So there is minimal difference between regardless of the tenor. Short-term and long-term are almost the same. So when the yield curve is shifting from upward sloping to a downward sloping, you might see an inverted yield curve. A flat yield curve, sorry. Inverted yield curve is a downward sloping yield curve. Long-term debt instruments have lower yields than short-term debt instruments of the same credit quality. Okay, so this is what they look like: normal, flat, and inverted. Okay, so yield curves can change. Theories of yield curves. Expectations theory. It depends on your expectations of future interest rate movements. Investors have no maturity preference. You have no preference, right? You don't mind investing short term or long term for as long as your returns are good. They are risk neutral, but do not have expectations about future level of interest rates. Expectations for high interest rates. That means if you expect future interest rates to go up, the yield curve will be positive. Expectation for lower interest rates. If you expect interest rates to drop, you will have a negative slope yield curve. If you expect interest rates to remain unchanged, you will have a flat yield. That's how the yield curve theories work. Liquidity preference theory. Investors sacrifice yield in order to obtain liquidity. Right? So if you are more conscious about liquidity, you might be able to, or you might be willing to compromise on return for as long as there is liquidity. Right? So investors prefer liquidity and borrowers prefer long-term funds. So investors, if you're an investor, you want liquidity. Whereas if you're a borrower, like a corporate, for example, might prefer to have long-term guaranteed debt, credit line long-term. Long-term bonds are less liquid than short-term bonds, right? Usually short-term bonds are more liquid than long-term. Liquidity premium leads to positive slope, which means longer the maturity, the higher the positive slope is there. And you'll have a normal yield curve. Upward yield curve does not necessarily imply interest rates will go up in the future. If your yield curve is sloping upward, it means it doesn't mean you expect interest rates to go up. It just means you prefer to have liquidity. Segmentation theory. Based on market segments. Now, there are different types of investors. Some might be short-term oriented. They prefer short-term funds, like banks, for example. Banks are very concerned about liquidity and all that. So, their time horizon may be short-term, whereas long-term, if you take an insurance fund, life insurance fund, long-term liabilities, huge liabilities, sometimes going up to about 100 years. Right? If your liability is long-term, you would like to have long-term assets also. But if your liabilities are more short-term to medium-term, then your liabilities also, assets also should be short to medium-term. Commercial bank, short-term funds, and insurance funds are long-term funds. Investors have preferred segments dominated by liabilities. Right. So the preferred segment is decided by the nature of your liability. Right. Now, for example, even between insurance companies, life insurance and general insurance, life insurance might be long-term, whereas general insurance is short-term. So depending on the nature of the liability, you will either have long-term assets or short-term assets, or preference for long-term assets or shorter-term assets. Neither borrower nor investor is willing to shift from one sector to another. And so banks will not want to go to 100-year loans. Insurance company will not want short-term, very short-term assets. Shape of the yield curve depends on the demand and supply of securities within the sector. So if there is no demand or no supply, then that also can have an impact on the shape of the yield curve. Investment grades we have done, two grades, investment and non-investment. Non-investment is also called junk. Right, so investment grade is from AAA to BBB minus. Junk is BB plus and below. So as you come down from AAA to AA plus, then AA minus, A plus, A minus, triple B plus, triple B minus. Those, as you come down, the risk or the credit risk also increases. And now these are given by credit rating agencies. Right. What we discussed last week: S&P, Moody's, Fitch, and Accrued. These credit rating agencies will assign a credit rating. Can either be investment grade or non-investment grade. So non-investment grade is junk. It's called junk investments. Anything from double B plus downwards are junk. Triple B minus and above are investment grade. Factors affecting overall GSEC returns, government security returns, return on bonds. What are the factors that affect? You can have macroeconomic factors, right? The political, legal, economic, social, and technological factors. Now, for example, if there is political instability, no one will want to invest. Political instability. So that's why sometimes in Sri Lanka you see foreigners selling and exiting markets, exiting bond markets when there is political instability. Right? Any country, this can happen. If there is no stability, investors will lose confidence and they will try and exit. So it happens if there is political instability. The legal and regulatory factors. If legal and regulatory factors facilitate investments, now it's easy to attract investments, right? For example, if you take Foreign Exchange Act, if it encourages foreigners to come and invest locally in bonds, and also to repatriate whatever the sales proceeds without any hassle, then there's incentives for foreigners to come and invest in local markets. Right now, if you look at the US market, interest rates they offer are very low, sometimes below 0.5%. Whereas if they had invested in Sri Lanka, they would have got 5 to 6% returns. So rather than half or sometimes even negative rates, they might as well invest in 5-6% Sri Lankan bonds. But the issue is if our legislation don't allow foreigners to come and invest, then there will have real problems. That's why central bank relaxed some of these conditions to encourage more investments coming in. Excuse me. Economic factors like exchange rate, inflation, GDP growth, unemployment, commodity prices, monetary and fiscal policy. So monetary policy is the central bank's action on interest rates. If central bank is reducing interest rates, it might warrant foreigners to come and invest because they can have capital gains, right? But if it's contraction in monetary policy, that means if interest rates are being tightened or increased, then foreigners might exit because they will have losses on their bond portfolios. Fiscal policy is the government policy on taxes, state revenues. If governments run short of funds, then they will have to come and start borrowing. Right now in Sri Lanka, the biggest borrower in the country is the government. Stock market returns. What is happening in the stock market? If stock market is doing well, there will be exits from bond markets and investments into the stock market. And so you rebalance your portfolio from bonds into stocks. Geopolitical factors. What is happening globally? Because no market is a watertight compartment. All markets are integrated in one way or the other. And nothing is in isolation. What happens in the US or what happens in UK has a direct impact on Sri Lanka. Now look at typical example is look at COVID-19. What has been the implications? Okay, so it's a geopolitical factor, something that happened in China, but a huge impact not only in Sri Lanka but on the whole world. So it's geopolitical factors, right? Geographical factors. The political factors, what is happening globally in politics, right? US-China trade war, geopolitical factor. The liquidity in the market. Now these days, central bank has pumped 300 billion I'm not mistaken, into the market. Maybe it was 150 billion into the market, right? So they pumped money to create liquidity. You can remember quantitative easing by the central bank, by the Federal Reserve, was also to inject liquidity into the market. Like banks are short of liquidity during the subprime mortgage crisis. That had to be mitigated, and the Federal Reserve went on a quantitative easing cycle to pump liquidity into the market. Right. So how do you calculate the discount on a bond? Let's try the first example. Read, a lender has bought a paper at 100 rupees, so 1 year, and receives 110 in 1 year's time. Another way to look at it is an investor had bought a paper at a discount to the face value of 110. If the amount of discount is 10, discount rate. So how do we calculate? Very simple. There is no rocket science in this. So today, he's buying it for 100. When it matures in 1 year, he receives 110. Right? So if you look at this transaction, he is receiving 10 bucks over this investment horizon. It's 10. His face value is 110 into 100. He gets a 9.09%. His discount is 10 rupees divided by face value, gives you the discount. Let's do the second one. Second one, bank buys a treasury bill on 12th June for 4,871,083. The government is due to pay back the face value of 5 million at maturity on 11th December. What is the discount the bank received and what is the discount rate? So how do we calculate? June. bank buys for 4871083. So it matures. The investor will receive 5 million. On 11th December. What is the discount the bank received and what is the discount rate? The face value is 5 million. They invested 4871083. What is the discount the bank received? What is the discount? Very simple. This face value minus present value. It's 5 million minus 0.71083. Which comes to very simple, right? One, two, eight, 9, 7. That is the discount they received. Then the discount rate is the discount divided by the face value into the number of days. Now you need to know the number of days. These are 6 months, right? So it's June, July, August, September, October. June to July 30 days, July to August 31, August to September 31, September to October 30, October to November 31. November to December is 30, but 29 days, right? 1 day less. These are 30, 31, 31 plus 30, 31, 90, 120, 182 days. 182 days. So it's 1 divided by 182 over. That will be bills. Remember the day count base is 364. But even if you use 365, it does not matter. You need to annualize. That's what you're doing into 100%. The discount in this case 128,917. divided by face value 5 million to 364 over 182. This is 2. .16%. Right, so the discount rate is 5.16%. The discount amount 128,917. So I hope that is clear. Let's now try the next question. Question number 2. The bank buys a treasury bill on 12th June at a discount rate of 5.16%. The government is due to pay back face value of 5 million at maturity on 11th December. So bank buys on 12th June, discount rate 5.16. On 11th December, they pay back a face value of 5 million. What is the discount the bank is received without any calculation? It looks identical to this. So these are the answers, right? But let's work this out. Let's do the reverse calculation. The bank buys a treasury bill on 12th June. And discount rate of 5.16. So discount rate $5.16. Government is due to pay back face value 5 million on 11th December. What is the discount the bank received? How much is the discount? These are up to you to calculate. So it's a treasury bill. Day count basis 364. And remember, even if you use 365 at the exam, you won't be penalized, unlike, right? But it's good if you can use 364 for treasury bills. It shows your knowledge that you know something additional. And that is what separates the men from the boys. Okay, so how do we calculate? Let's calculate the discount rate. Put the formula. Discount rate is the discount divided by the face value into number of days. In this case, 182 into 364 and 100%. This is 5.16 discount. Face value is 5 million. into 364 over 182 minus 100%. So let's calculate. You get 129. Small difference is due to rounding. I hope that was clear. Then the rate of return. Yield to maturity. Yield to maturity is if you buy a security and you keep it until it matures. What is the return you're going to get? Holding period return is if you had bought a security and in between, if you had sold it somewhere, what was the return you got for the period that you held it on? Right? So let's calculate these. First one is a bank takes a deposit of 1 million from a customer on 22nd July and commits to pay back 1,025,205 cents 48 on 22nd October. What is the yield to the customer? So it's a simple calculation. Now remember, discount was based on the future value. Discount based on the future value, whereas yield is based on the investment value. Okay, this question. A bank takes a deposit of 1 million from a customer on 22nd July and commits to pay back 1,025,000 on 22nd October. What is the yield to the customer? Right, let's draw the diagram. Twenty-second July. $1 million. 22nd October. Then 25,205 and 40. So you need again to calculate the number of days, compute the number of days. 22nd July, 22nd August, 22nd September, then 22nd October it matures, 22nd July to August, 31, August to September 31, September to October 30. So this is 92 days. The yield to the customer will be the future value minus present value divided by present value into the date on basis 92. Now in this case it's a deposit, so it's 365. So that's a return of 10%. The return to the customer is 10%. I hope this is clear. If you have any questions, you can always ask me next week when we come back on Campact Live. But in the meantime, you will have to try these examples. Unless you try, you will not understand. Like the best place to try is in class, because if you try and you fail or you come across any difficulties, you can always ask. Feel free to ask questions. Right, so question number 2. A bank buys a treasury bill on 12th June for 4,871,083. Government is due to pay back the face value, 5 million, on 11th December. What is the yield to the bank? It's similar to what we did earlier. Remember, this is holding period return. 12th June, 11th December. We did it earlier, it's 182 days. Face value, 5 million. The yield, the bank is the face value and its present value divided by present value. Right? The yield is based on holding period return is based on percentage. Remember, it's not the discount, it is the yield. They ask you for the yield. And in this case, it becomes a holding period return because this has already matured. 364, 182. Again, 871, 083. 5.29%. If you all could remember, the discount rate was 5.16. Yield 5.29%. Right. So discount rate and yield are two different things because yield is based on the investment amount, the present value. Discount is based on the future value, the maturity. Right, so if you want to calculate yield based on the discount rate, this is the formula you can use. Okay. If you want to start from the yield and start from discount rate and calculate yield, this is the formula you need to use. If you substitute the discount rate that we calculated earlier to this formula, you will arrive at the yield. Right, so that's the first part on fixed income. And we move on to the second part. Now this area is called bond price sensitivity. Right, so bond price is sensitive to mainly the interest rate. Remember, there is an inverse relationship between yield and price. Bond price is inversely related to yield. Right. It is also inverse. There is also a relationship between the tenor. That means longer tenor bonds and shorter tenor bonds will have a different price sensitivity. Then the coupon rates, right? Which means if one has the same maturity but two different coupons, then they are likely to have different sensitivities. Right. So if we look at bonds, several bonds with different coupon rates, 0%, 5%, and 10%, and maturities of 5 years and 20 years. Right. With and at various yields. Let's see what it looks like. Okay. So this is the summary of the study. We have analyzed the prices for various yields, right? Yields starting from 7%, going all the way down to all the way up to 13% at 1% intervals, right? Except around 10%. Then we looked at various coupons and maturities. So here we have 10% 5-year bond, 10% 5 year, 5% 5 year, 0% 5 years. So for 5-year tenor, we look at three different coupon rates: 10%, 5%, and 0%. Then for 20 years, we look at another three, right? The same three: 20-year maturity, 10%, 5%, and 0%. Now, based on this, what happens if starting at 10, let's say 10% is the starting yield, right? If interest rates originally, let's assume it starts at 10%, yield is 10%, right, across all tenors. Now, what happens if the yield drops by 0.01%? 0.01 or 1 basis point drop in interest rate yield, which out of the 5-year, right, out of the 5-year bond, which one increases the most? Why do I say increase when interest rates drop? When interest rates drop, bond price and yield have inverse relationship. When any yield comes down, the bond price has to go up. So which one will increase by the most? For a 0.01% drop in the 5-year tenor, 10% bond will increase by 0.04. The 5% bond will increase by 0.03, right? And 0% will increase by 0.03. But as we go beyond that, the same applies, isn't it? See, from 10%, if interest rates drop to 9%, right? The price on the 5-year 10% is increasing by 3.89. The 5% is increasing by 3.39. And the 0% will increase by 2.9. Right. Then if interest rates go up from 10 to 10.01, prices will drop. Isn't it? Right. So if you look at 10% and 7%, the 10% increases, yield goes from 10% to 7%, right? The 5-year 10% increases by 2.3. The 5-year 5% increases by more than 10%, by 10. And the 0 coupon goes by 9 point something, right? So basically what you should understand is the lower the coupon, the more sensitive a bond, right? Low coupon bonds are more sensitive. Likewise, if interest rates go up from 10% to 13%, the price drop in the 5-year is 10.5, and price drop in the 5% is 10.8, and 5% in the 0 coupon is 8.2. Okay, so lower the coupon rate, higher the change in price. That is generally how it works. So likewise for the 20-year, lower the coupon rate, when you go down from 10% to 0%, the price change is more dramatic. Then if you look at, right, this shows the summary of it. This shows the summary. If price yields drop, the high coupon bonds will increase by a lower amount, whereas lower coupon will increase by a higher amount, right? So lower the coupon, higher the change in price. Likewise, if prices increase, the high coupon will change by less and the low coupon will change by more. So lower the coupon, higher the change, either up or down. Likewise, for longer tenors, same. Yeah, lower the coupon, higher the price change. That is how bonds work. Right? Lower the coupon, higher the price change. That means if higher the price change for the same drop in interest rates, the low coupon bond is more sensitive than high coupon bond. Okay. Higher the price change, low coupon bonds are more sensitive than for a given price change, low coupon bonds for given price change. Remember, this is what you need to remember. For a given price change, low coupon bonds are more sensitive than high coupon bonds. I'll come again, right? For a given change in yield, not in price, for a given change in yield, low coupon bond prices change by more than high coupon bond prices. So that means low coupon bonds are more sensitive than high coupon bonds. Bond price sensitivity. Price sensitivity not uniform for all bonds and depends on the bond maturity, right? That means it is positively related. So if you have a bond, let's say for example, two bonds. One is both are 5-year. One is 10% coupon, other one is 5% coupon. Let's say this is A and this is B. Then there is another bond. Let's say third bond is 10-year maturity and the coupon of 5%. C. Now between A and B, which one is more sensitive? A or B? A is 5-year, B is 5-year. 10% coupon, B is 5% coupon. B is more sensitive, right? Lower the coupon, higher the sensitivity. So B will be more sensitive. B is more sensitive. Lower the coupon, higher the sensitivity. Inverse relationship. Then what about the tenor? Between B and C, which one is more sensitive? Both have 5% coupon. Coupon are the same. Tenor of B is 5 years, tenor of C is 10 years. 10-year or the longer tenor is more sensitive. Let's out of these bonds, C is the most sensitive one. It has the longest maturity and the lowest coupon. Okay. The bond maturity, longer the tenor, longer the sensitivity. And shorter, lower the coupon, higher the sensitivity. Yield to maturity also, higher the yield, lower the sensitivity, lower the yield, higher the sensitivity. Measures of bond price sensitivity needs to take into account all cash flows and reinvestment risk. Bonds price sensitivity changes in interest rates. It is measured using what we call as duration. And so duration is the measure of bond price sensitivity to changes in interest rates. What is the sensitivity of a bond price to changes in interest rates? That's called duration. Duration is the effect is a measure of effective maturity of a bond. It measures what is the effective maturity of a bond. Now, the easiest way to remember, if you all could remember, payback period. It means how long you take to recover your investment, isn't it? Payback, then discounted payback. Discounted payback gives also it considers time value of money and it tells you how long it takes for you to pay back your investment. So likewise, if you take a bond, say this is a 3-year bond, annual coupon. Let's say this is a 3-year bond, annual coupon. 3-year bond, annual coupon. And let's say the yield 12%. If we could recall properly, we got a price of about 95. The percent value of 95. Right? Now, if you were to buy this bond, your investment will be 95. Right? So you have cash outflow of 95. Then the first year you are 95 minus, and then you get 10. So it's 85 minus. From 95 minus, you go to 85 minus. Second year you get another 10, so you go to 75 minus. This is your cumulative cash flows. From 95 you are going to 85 and then to 75. Okay. And so this is a simple payback calculation. From 75 plus 10 is third year you will end up with 35, positive 35. Somewhere in between the second and third year, you will recover your investment. Right, somewhere in between the second and third year. Now, this time period is what duration actually measures. The weighted average time to recover the cash flows. How long it takes for you to recover your cash flows. That is what duration measures. It's the weighted average, duration is the weighted average life of all cash flows. Weights are the present value of cash flows, fundamental measure of interest rate risk. So remember, duration measures the interest rate risk. Duration directly related to price sensitivity. Right. The duration is calculated as sigma of the total of present values into time divided by the total of present values. This is total of present values into time divided by the price. It is also calculated as minus. I will come to that later. So this is how duration is calculated. Duration, the factors affecting duration are the maturity. Right? Longer the maturity, remember what we did earlier, bonds A, B, and C. Longer the maturity. 5-year bond with longer maturity, 5% coupon bond with longer maturity is more sensitive. Longer maturity bonds have longer duration. Then low coupon have longer duration. Inverse relationship, if you all can remember. And yield, also inverse relationship. Low yield regimes have longer durations than high yield regimes. Frequency, Higher the frequency of receiving coupons, lower the duration. Lower frequency, high duration. And higher the duration, greater the interest rate sensitivity. Now that's the most important point. That's a critical point. Higher the duration, greater the interest rate sensitivity. Longer duration bonds are more sensitive to interest rate changes. Duration says something about bond price volatility. The best way I could explain this using an illustration. If you have coconut trees, and next to that, let's say there is grass. Coconut tree is taller than grass, right? It's taller. Now, if there is wind, which one will move more? The coconut tree moves more or grass moves more? Obviously, coconut tree moves more. Right? If the wind is the interest rate. And the height is the duration. Long duration bonds are more sensitive to interest rate changes than shorter duration bonds. It's an analogy. The duration is all around us. We never understood until we saw the tree and the grass. Right? So it's all about duration. Look at nature, it's duration. You should be able to grasp this. Long duration bonds are more sensitive to interest rate change. Simple as that. All right, so let's try this example. Four-year 10% coupon bond selling at 100. Four-year 10% coupon bond selling at 100. In other words, the price is 100. If the price is equal to the par value, obviously the yield should be equal to coupon. So yield is 10%. Price is obviously 100. You don't have to calculate this. And straight away put price is 100, but For a particular reason, you need this. Why? Because you have to calculate duration. Duration is called here as T. So let's leave it at N. Right, so present value into N. Present value 9.091 into N is 1. 8.26 into 2. Total of present value into N 348.678. Duration. Three point four eight. This duration is called Macaulay duration. 3.48. Then there is another derivative of duration called modified duration. Which is the Macaulay duration divided by 1 plus 3.48 divided by 1.1 3.17. Duration is measured in years. So you have got the answer. Now how do you interpret this? Modified duration means if interest rates change by 1%, the bond price will change by 3.17%. Right? That is the meaning of this 3.17. So usually when you calculate duration, you need to calculate modified duration. Next question. 4-year zero coupon bond selling at 100. 4-year zero coupon bond sitting at 100. You get coupons of 0. And it matures, you get 100. That's the only cash flow. All of these high period. Price is 68.3. Macaulay duration. Macaulay duration. Remember, Macaulay duration of zero coupon bond is equal to maturity. With a zero coupon bond, the Macaulay duration is equal to maturity. Modified duration is three 3.64 years. So we have some similar calculations. You all can try this. The most important thing is the interpretation of duration. How do you interpret duration? Duration is the weighted average maturity of a bond's cash flow, where the present value of cash flow serves as weights, right? Like what we discussed earlier. The duration of a bond is the term to maturity of its equivalent zero coupon bond. Now, what it means is the duration of this bond, right? The previous example we did. This one. Right. So the Macaulay duration of 3.49, it means the bond with this bond, the given bond with a duration of 3.49, Macaulay duration of 3.49 has the same interest rate sensitivity as a bond, as a zero coupon bond with a maturity of 3.49 years. So this bond, which has a duration, Macaulay duration of 3.49, has the same interest rate sensitivity as a zero coupon bond with a maturity of 3.49 years. That is what duration means. Duration is the future point in time at which, on average, an investor will have received half of the original investment in present value terms. It is the balancing point of a bond's cash flow streams where the cash flows are expressed in terms of present values. Right? So it's like the payback period, in other words. Okay, so it is like a tangent to the price yield curve. This is what duration means. Calculating duration. So let's try this example. First one, 3-year bond. Pays coupon of 8%. Okay, so cash flows 8, 8, and then 8. Yield to maturity 10%. Then the present value into time. It comes as 2.78. Likewise, you can try the other example. Duration. Interest rate risk, as we are using it here, refers to the sensitivity of a bond. Sorry, I'm not sure whether you also saw what I wrote on the board. Take a minute. It is the calculation, and you end up with 2.78. Now, what this means is this bond has the same interest rate sensitivity as a zero coupon bond with a maturity of 2.78 years. That is what it means. All right. Interest rate risk, as we are using it here, refers to the sensitivity of a bond values to changes in market interest rate risk, right? Interest rates. So when interest rates change, by what percentage is the bond price change? Duration is a measure of price sensitivity of a security to changes in yield. Specifically, it can be interpreted as an approximation of percentage change in the securities price for a 1% change in yield. When interest rates change by 1%, or when the yield change by 1%, by what percentage does the bond price change? That's called duration. So it can be calculated using this formula. Again, you have to remember the formula. There are a few formulas to remember when it comes to duration. Duration is percentage change in price divided by the change in yield. Price change is proportional to duration and not to maturity. Right? So the price change is proportional to duration and not to the maturity. And modified duration is the Macaulay duration divided by 1 plus the interest rate by 1 plus the yield. And let's try this example. If a bond yield rises from 7 to 8% and price falls 5%, calculate duration. The duration is minus percentage change in price divided by the change in yield. This one says bonds yield rises from 7 to 8%. So yield is increasing by 1%. Increasing, right? So it's plus 1%. Remember, don't forget the negative sign in between. Price falls by 5%. 5% minus duration is 5, isn't it? Next one, if a bond has a duration of 5, the duration is 5. And yield increases from 7 to 8%. Yield is going up by 1%. Calculate approximate change in percentage change in the price. Also, percentage change in price will be 5%. Right? Remember, it is minus because there is a minus sign. Don't forget the minus sign. Third one, a bond has duration of 7.2. If the yield decreases from 8.3 to 7.9, yield is decreasing from 8.3 to 7.9. And that means a minus. There is a minus drop. 5.4% minus. If yield is dropping, the bond price should increase. Percentage change in bond price will be 7.2 into 0.4. It becomes plus because of the minus sign. %. Bond price increases by 2.88%. Right. So next concept is convexity. If you look at the bond price, it's not a straight line. Whereas duration assumes bond prices changes as a straight line. Right? Bond price is not a bond price against yield is not a straight line, whereas duration assumes that it is a straight line, which is not correct. So the adjustment comes from what we call convexity. Convexity is a measure of the curvature of the bond price yield curve. The more curved the price yield relation, the greater the convexity. Right? Straight line has convexity of 0. If the price yield curve were in fact straight line, the convexity would be 0. The reason we care about convexity is that more curved the price yield relation is, the worse our duration based estimates of bond price changes in response to changes in yield. Right? So you need to make an adjustment for convexity. By combining duration and convexity, we can obtain the more accurate estimate of the percentage in price of a bond, especially for relative large change in yield. The formula is based on the bond's percentage price change based on its convexity and duration, right? The actual price change of a bond based on this equation. Percentage change in bond price is minus duration to change in yield. Right? But this is not correct because this is not a straight line. So you have to do an adjustment for convexity plus convexity into change in yield. Right. That is your adjustment. This is the actual change in the bond price. Example, consider an 8% treasury coupon treasury bond with the current price of 908. Yield to maturity 9%. Calculate percentage change in the price of both 1% increase, 1% decrease in yield based on duration of 9.42, convexity, duration 9.42 and convexity 68.33. One percent change in yield is 1%. What happens when the interest rate increase by 1%? Minus duration is 9.42. 1% plus 68.33 into 1%. Right. Then if interest rates drop by 1%, the change in bond price will be minus 9.42 into minus 1% plus 68.33 into 1%. Right. It is 9.43% minus plus 8.73% minus. Here it is 9.42 plus 0.63. And 0.10. That is the impact. Risk in bonds, interest rate risk. If you invest in a long-term bond and interest rates go up after you invest, right, then you will lose out. Yield curve risk, after you invest, if the yield curve changes, there is a risk. You might make losses. Call risk, if interest rates, if you invest in a callable bond and interest rates drop, the bond might get called. Prepayment risk, before the bond matures, if the borrower wants to settle it, there is prepayment risk. Reinvestment risk, after the bond matures, if you have to reinvest at a lower rate, it's called reinvestment risk. Credit risk, very obvious, default. Liquidity risk, if you buy the bond with the intention of selling, but you can't sell because it's illiquid, it's called liquidity. Exchange rate risk, if you buy a foreign currency denominated bond and the foreign currency weakens, it's called exchange rate risk. Right? So there is also inflation, volatility risk. Volatility is the price fluctuation in bonds. Event risk, something like a tsunami or a COVID-19 happens. Maybe fundamentally it may have been strong earlier, but because of unforeseen reason, it might default. Sovereign risk, the risk of a government default. All right, so that's it on fixed income. Thank you very much. We will meet next week live with a new topic. I hope you understood what we did today. If you have any questions, you can always ask next week when we meet live. So thank you very much. Stay safe.